Hello, we'll start our program in just 1 minute after everybody's had a chance to log in. Good afternoon. I'm Keith Brandt, and I'm the president of California Wealth Transitions. We are a boutique firm specializing in advanced planning strategies to minimize income and estate taxes. I spent 29 plus years at Merrill Lynch, and among other responsibilities, one of my jobs was to help educate advisors in advanced planning strategies. Today, we're going to share one of these techniques with you in regards to Roth retirement accounts. If you find this information helpful, please contact us to talk about some of the other services and techniques that we can use to help our clients minimize taxes. Now I'll turn the program over to Blake Murphy.
Thanks, Keith. I'm Blake Murphy, a financial advisor with California Wealth in San Diego. Before we get into the presentation today, I'd like to point out a couple of housekeeping items. We're going to be taking questions throughout this webinar. So if you have a question, you could submit it using the Q&A feature located at the bottom of your Zoom window. If we do not get to your question during today's presentation, we'll follow up with you after the webinar is complete. So to start today's discussion, we're going to briefly get back to the basics and then get into some more advanced Roth strategies. So what are the benefits of a Roth, and why is it important to get as much money as we can into Roth accounts? Well, in regards to saving money in retirement accounts versus a regular investment account, the benefits are on the tax side. So there are many types of retirement accounts with different tax features. Today, we're going to be focusing specifically on the accounts that have the best tax features, which are Roth accounts. So back to the basics, money contributed to a traditional retirement account, such as a traditional IRA or 401k, is contributed before that it's taxed. That money grows over time. However, since you've contributed money that has not been taxed, the government taxes it when you take the money out down the road in the future. The idea is that when you take the money out in retirement, you have a lower income tax rate than you currently do while you're working. Roths work in the opposite direction. You pay tax on the money before you contribute it, and then when you take the money out in retirement, you do not have to pay tax on the withdrawals since you already have. So what's the key point here, and why does it matter to you? I'll use a quick example. If you invested $100,000 in a traditional IRA, and over time it grew to $200,000, we'll say for simplicity's sake, you take all the money out at once to buy a house or something. And when you do that, you would owe taxes on $200,000. Now, conversely, if you had invested that same $100,000 into a Roth, which also grew to $200,000, you would only pay tax on the initial $100,000 when it was invested, but no tax on the $200,000 when you take it out later. So in a Roth, that $100,000 of growth in the account would not incur additional tax. In an IRA, you pay tax on the growth of the account. In a Roth, the growth of the account is not taxed. So for this reason, money in a traditional retirement account is considered tax deferred. Money in a Roth account is considered tax-free. So there are two types of Roths. There are a Roth IRA and a Roth 401k. So we're going to quickly look at some of the most frequently asked questions, and I'll discuss the differences between the two of these. So commonly asked questions, what funds can you contribute? How much can you contribute each year? Can your spouse also contribute? Can you contribute to a Roth IRA and a traditional IRA in the same year? And what are the income limitations on Roth IRA contributions? So when looking at the Roth IRA, what funds can you contribute? For a Roth IRA, you can only contribute earned income, meaning income that you receive from your employer or earned income from your business. If you don't work and don't report income in a given year to the IRS, then you can't contribute. How much money can you contribute? Well, as of 2020, you can contribute up to $6,000 or $7,000 if you are age 50 years or older. Can your spouse contribute? Your spouse can contribute whether they generate their own income or not. So if you have earned income and your spouse does not, you could contribute $6,000 in your own Roth and $6,000 in a Roth for your spouse for a total of $12,000 per year. Can you make Roth and traditional IRA contributions? Yes, you can. However, you can only contribute the maximum among all IRA accounts. So you can't contribute $6,000 to a Roth and $6,000 to a traditional IRA, but you could contribute $3,000 to a Roth and $3,000 to a traditional IRA, as the sum equals the maximum of $6,000 per year. The issue that we run into with Roths is that they have income limits. So if you're single and you make more than $139,000 in a year, then you cannot contribute directly to a Roth. If you're married and your joint income is greater than $206,000 a year, then you cannot contribute directly to a Roth. However, just because you can't contribute directly to the Roth because your income is too high does not mean that you can't get money into one. And so we're going to dig into a couple of strategies shortly that allow you to get around those income limits. So now we'll look at the Roth 401k. With the Roth 401k, you can only contribute funds that are earned through your employer. You can defer a portion of your salary into a Roth 401k, the same as you would a traditional IRA. The key difference between the Roth 401k and the Roth IRA is that for a Roth 401k, you cannot contribute money from a savings account into the Roth 401k. It has to be direct from your income from the employer. Roth 401ks allow you to contribute up to $19,500 per year or $26,000 if you're age 50 or older. Your spouse cannot contribute to your Roth 401k, but they can contribute to theirs. You each have to have your own separate account and your own earned income. The same contribution limits apply as the Roth IRA, so you can make some pre-tax 401k contributions and some Roth 401k contributions, but the total dollar amount contributed for a year can't exceed the maximum, which again for a 401k is $19,500 per year or $26,000 if you're 50 or older. The biggest difference, Roth 401ks do not have income limitations, unlike Roth IRAs, which do, as we discussed on the last slide. So I know I just covered a lot, so I want to pause for just a moment and see if we have any initial questions.
Blake, we have one question. What is the maximum percentage I can defer into my 401k plan?
Okay, thanks, Keith. The IRS allows you to contribute up to 100% of your salary into a 401k. However, your company's plan may restrict you to a lesser amount. So what we often will recommend, assuming that your cash flow allows it, is that people set their contributions to 100% of their salary in January, so that the bulk of the salary is going into the 401k, which allows it to grow throughout the entire year rather than adding to it each month. It's essentially a strategy to front load your 401k contributions and get the maximum amount of growth out of it. So now I'm going to turn it over to David, who's going to discuss some more advanced strategies. David?
Thanks, Blake. Hi, I'm David Brandt. Now that we've covered the basics on Roth retirement accounts, we're going to talk about some of the advanced strategies to help you maximize your Roth contributions. As we just heard from Blake, there are lots of limits on Roths, limits on contributions, limits based on income. So we're going to look at two strategies to get around those limitations. The first strategy is how to get money into a Roth if you're over the income limits. The second strategy is how to execute a mega backdoor Roth. Next slide, please. So if you make over $139,000 and are single, or over $206,000 and are married filing jointly, you're thinking you can't make a Roth IRA contribution, right? To get around that, we like to have you utilize an often overlooked provision in the tax code that allows you to make a non-deductible contribution to a traditional IRA. Again, this is a non-deductible contribution. Most people don't do this because you don't get the tax deductions, so they think, why bother? Here's the beauty of this. There's no deduction, but there's no income limitations either. So this is after-tax money. The contribution limit still applies, so you can only put $6,000 in or $7,000 if you're over 50. But now you can transfer this traditional IRA with after-tax money in it into a Roth IRA with no tax consequences. And you can do the same thing for your spouse, allowing you to put $12,000 or $14,000 if you're both over 50 into your Roth IRAs, regardless of your income. Next slide, please, Blake. Now, there are a few things that you need to be aware with this type of conversion. This only works if you have no other pre-tax IRAs. If you have other IRAs, it becomes a little bit more complicated, and we should walk you through this scenario and discuss it with your tax advisor. So just email us. Let me give you an example. If you previously rolled an old employer's 401k into an IRA, then that IRA, of course, has pre-tax contributions in it. Doing a Roth conversion at this point will initiate a taxable event. The IRS sees all IRAs in aggregate, regardless of how many you have or where they're held. But if you don't have any other IRAs, this could be a great strategy for you to put away funds to grow tax-free. So we had someone come to us. She was an executive with a major company, and she was making good money. She couldn't do a deductible IRA or regular Roth IRA contribution, but she'd been making non-deductible contributions to her IRA for years. She made $71,000 of non-deductible contributions in her IRA. It had grown to $105,000. These non-deductible contributions were growing, but she was going to owe taxes on all the growth when she withdrew the money. So we had to remove the $34,000 of growth, and then we converted the $71,000 into a Roth IRA. There was no tax on the conversion, and now all of her money will be able to grow tax-free rather than tax-deferred. The account can double in value, and she won't owe any taxes when she withdraws the funds. I'm going to pause here, see if there's any questions.
David, you were talking about the non-deductible contributions into the IRA. Can I make those contributions for both me and my spouse every year?
Yes, good question. Yes, you can put $6,000 in, and your spouse can put $6,000 in, so you could potentially put $12,000 away tax-free every year, or $14,000 if you're both over 50. So now I'm going to let Keith go ahead and explain how to utilize the mega backdoor Roth strategy.
Okay, thank you, David. So we talked about how to get more money into a Roth IRA. So how do we get more funds into a Roth 401k, also known as the mega backdoor Roth? Blake, can we go to the next slide? So as you're well aware, I assume you're aware by now, the maximum contribution you can make in a Roth 401k is $19,500 per year. In order to make that contribution, to fully fund your Roth contribution, you have to reduce your pre-tax contributions. So if you have a high income, most of us do not want to give up that $19,500 per year deduction, or $26,000 if you're over the age of 50. So that's a big barrier for people to put money into a Roth 401k, is the reluctance to give up that tax deduction. So the question is there a way to fully fund your 401k with $19,500 of pre-tax contributions and contribute to a Roth 401k in addition? The nice answer is yes. So we're going to talk a little bit more about that. Blake, let's go ahead and go to our next slide. So all 401k plans allow pre-tax contributions. Some 401k plans allow Roth contributions. The thing that most people don't look at is some 401k plans also allow for after-tax contributions. So it's not Roth contributions, it's its own category called after-tax contributions. So how do I know if my plan allows this? Well, some large company plans typically would offer this. Qualcomm offers it, Pfizer offers it, Johnson & Johnson offers it, and many other large plans. There are also some smaller plans that might offer this feature. If your company's advanced in what they're doing in terms of employee benefits, they may offer this as a benefit. For example, at California Wealth Transitions, I mentioned earlier, we're a relatively small company. We have this provision in our 401k plan. So if you work for a large company, you can talk to your HR department or even log into your site and see if there's a category for after-tax contributions. If you're not sure and you can't figure it out, let us know and we're happy to help you walk through the website and look at it with you. If you work for a small company that does not offer this feature, give us a call and we're happy to get on the line with you and your benefits department and maybe explain why this would be a benefit to their employees and perhaps help them set up this option. So if your company allows for after-tax contributions, then you can contribute up to $37,500 in after-tax funds, which could then be converted into a Roth. I'm going to say that one more time. So you can contribute your $19,500 in pre-tax contributions and get your tax deduction. And then in addition to that, you can put in another $37,500 in after-tax funds to give you the full Roth contribution. Let's go to the next slide, please, White. So who should take advantage of this strategy? We think that anybody that's a high income earner and has the ability to save large amounts of money, this is a great way to build up a bunch of money in a Roth 401k quickly. Corporate executives would be in that situation, or maybe if you have your own company. So as an example, we had a client that came to us and they were 2 years away from retirement and trying to maximize their savings before they retired, as many of us do in those final years. So we had them go into their 401k plan, contribute $26,000 a year in pre-tax to get the maximum deduction. The company was making a matching contribution of $10,000 a year. So that was between their deferral and the company, that was $36,000. That still left them another roughly $30,000 a year they were able to put into their Roth. So in 2 years, it actually covered a couple calendar years. We put $90,000 into the Roth 401k before they retired, versus most people are lucky if they could put $6,000 a year in a Roth IRA. So it's a way you can really load up your Roth contributions just before retirement, which gives you a lot of flexibility after you're retired. Do we have any questions?
Yes, Keith, we had a question. How's the annual limit determined for after-tax contributions?
It's a good question. So most of us are familiar with the annual limitations on IRA contributions and the annual limitations on 401k contributions. The IRS updates that every year, and your employer or your tax executive or your advisor will tell you what those new numbers are. There's another number which is not publicized as much, and that's the total amount that can be contributed to a retirement account in 1 year. So in 2020, the total amount that can go into a retirement account is $56,000 if you're under 50, or $62,000 if you're over age 50. And that number covers what you defer, and then it covers any company contributions like safe harbor contributions or profit sharing contributions, and then it includes after-tax contributions. So depending on how much you defer and how much the company puts in, if that's less than $56,000, whatever that gap is how much money you can put into as an after-tax contribution to your 401k, which can then subsequently be converted into a Roth. So I thank you all for listening today. I apologize if we didn't get to your questions. We wanted to keep this program relatively brief. On your screen is our contact information, our web address, our email and phone number. We talked about a lot of technical information rather quickly, so we would encourage you to reach out to us if you had questions. We will be contacting you in the next few days to answer any questions that you may have or talk about any particulars of your situation that you're concerned about. There will also be a recording of this program available on our website in a few days. Feel free to go on there and review it again if you'd like, or share it with somebody else if you think that the information might be of benefit to them. Thank you again for listening today. Goodbye.